Well, hey, welcome back. I'm Chris Stallings, one of the wealth advisors here at Abundance. And for the last few years, I've been super blessed to have Casey Hazen join us. He's one of the senior portfolio strategists at Horizon. And today we're going to be doing the second quarter 2026 outlook and a little bit of a review. So that said, Casey, how's your summer been?
Summer's been good. It's been uncomfortably hot, but that's to be expected when you live down here in the South, right?
Yeah, that's true. It's we've got new languages about heat domes, and I see my plants struggling, and I don't know that I can afford to survive the heat dome and watering all this stuff, but we'll make it through one way or the other. But yeah, man, I it's good to see you. I was looking at some of the things that we were preparing, and it's I've had some clients kind of play a little bit of a game of not really sure if things are going to be in a bubble or if things will persist. And I think we've got some good news as it relates to some of the fundamentals continuing. But I would love to hear some of your feedback from what's been going on.
Yeah, absolutely. It has been an interesting start to 2026, to say the least, right? Lots of interesting tidbits to go through around the economy, around the market. One place that we have to start, right, is with AI. AI is making all of the headlines right now. Quite frankly, it's what's driving the economy. You and I have been talking about AI and some of the productivity benefits for the last handful of years at this point. But
Yeah.
that's not without, AI is not without some concerns, right? I think a lot of people are concerned about the idea that AI is going to completely replace everybody's jobs, especially entry-level jobs, any jobs related to tech. So we just want to bring some additional context around that, maybe spin a little bit more positive of the story with how AI can actually increase or improve the labor market. So there's this theory that's out there. It's called the Jevons effect. And basically, what it says is as technology creates efficiencies that actually lower the cost of a specific service, that service does not become, less desirable. It actually becomes more valuable to consumers. And as it becomes more valuable to consumers at a lower cost, that actually increases demand. It increases the ability for new customers to come in and actually purchase this service because now all of a sudden, it is more affordable. And that's what we have been seeing, right? Software engineers, now that they have the ability to use AI, we know that they're so much more efficient, right? A software engineer might be 5 times more efficient right now, coding, doing their day-to-day work, than they were before. And that could be viewed as a negative, right? Like that could be concerning if you're a software engineer that all of a sudden, you're so much more efficient. If you have the same amount of workload, then all of a sudden that employer can actually fire, 80% of those software developers. But on the other side, if all of a sudden, a whole new demand stream comes in, there's new clients that come in, new projects all of a sudden open up, demand can actually outstrip, that efficiency, and then you actually have to go out and hire more of these people. So that's something that happened back with Excel, right? Um, Bookkeeping, creating a ledger used to be a very, very physical, labor-intensive process prior to Excel. There was lots of handwriting in those ledgers. If you wanted to go and if your boss asked you to calculate, what would happen to our bottom line, our profits, if, rent increases 10%, even that very simple scenario took a lot of time. Could take that accountant, a full day's work just to try to manually calculate that. All of a sudden, Excel comes in and it takes away, a lot of the day-to-day data entry and the manual calculations. And so again, there was lots of concern that this was going to completely replace the job of these bookkeepers, the job of these accountants. But what you saw actually happen was all of a sudden the employers they started asking new tasks, new demands of these accountants. So it was no longer, hey, just type in all of these data entries into the ledger. It was, hey, run this analysis for us to see what happens if rent increases. What does that do to our profitability? what's our break even point at that, with that analysis. Run these projections. It just opened up a whole new avenue of work for these employees. And the chart here shows that there was a massive increase in hiring for accountants and bookkeepers. And really, I think that's what we're on the precipice of here. We had talked about in the past handful of quarters, job openings had been coming down here in the US specifically. One thing that actually has started ticking back up is job openings for software engineers, which again kind of flies in the face of a lot of these concerns that people have around AI completely replacing that type of job. And again, it has a lot to do with this somewhat complicated, somewhat nuanced Jevons effect. So, Chris, I don't know if you'd add anything to that or if you can expand on that at all. Hopefully, that makes a little bit of sense.
Yeah, no, I'm tracking with you. It's interesting. I had a friend of mine, a resource. He is a software engineer, and it's exactly what you're saying. He has a little bit of oversight, so he's got developers underneath him, and he's saying with AI right now, he could replace three or four of them. But I think that he's keeping them on for that very same principle. It's like, what's the future demand going to bring? How can they continue to be the masters of the tool versus letting the tool replace the master, so to speak? And so he found that there's greater productivity coming, but it's that I think the word's liminality, is that tension between the now and the not yet. And so to be able to bridge that gap is what I think he and his firm were trying to do. But it's real, and the adoption is still a long ways out as far as the market completely consuming what AI can do. So it's interesting to see, interesting thing to see how it plays out.
Yeah, absolutely. I mean, we have seen adoption at the corporate level pick up pretty significantly over the last handful of years. But even still, to your point, just half, a little bit more than half of the companies out there right now are even using AI. We know that AI is not without its faults, it's not without its concerns, right? There was a survey that came out earlier this year where it basically asked people like, what is your personal view on AI as it relates to the impact on society down the road? What's your view on AI's impact to you personally with your job outlook, your personal outlook? And it was, actually quite negative, more negative than you would normally see from a new technology, an innovative technology. And so this is something that is going to catch on from a political perspective. It could be a kind of a populist movement that you could see get picked up by politicians down the road. So we'll see exactly what happens because we could see potentially this technology become much more highly regulated, which, might be good in some respects, but it could also be more negative in some respects, as it would kind of tamp down on new innovation and our competitiveness with this new technology. So a lot more is to be seen on that front. But then your last point, Chris, I think that you were getting to this chart here,
Oh
um,
yeah.
just how much untapped potential there is with AI. So this graphic essentially just shows the entire global population and the percentage of people that have never used AI, percentage of people that have used some sort of like free chatbot, whether that's Google Gemini, whether that's ChatGPT. And then in the very bottom right-hand corner, you can see the percentage of the global population that actually pays for AI or uses it to its more fuller capacity, capabilities. Just 30 basis points, a significantly small portion of the population is really adept to use AI at this point. So a very long runway we feel like we have with AI continuing to grow. So very much still early innings here.
Yeah, I've consumed a good bit of interviews and podcasts around AI. I have some level of adoption. I have friends who've got crazy levels of integration that I'm just not ready to delve into yet. But it's the concern that I have. It seems like the chart that you had a couple of slides ago. We don't need to go back to it. Is the concern about it? I think a lot of it is just ignorant fear, right? So because most of the population is not following some of these industry podcasts and whatnot, I think they're just concerned. I mean, we've all watched Terminator, right? I think you're probably a little bit younger than me, but like Skynet becomes self-aware at some point. So I think that we have that programmed into us, pun intended. But at the same time, what is most concerning is when you hear from these guys who are already using it, whether they were with OpenAI or whomever, that the rush to bring a solution to market is such a blitzkrieg right now that there's a level of compromise in some of the development. Like, for example, getting ChatGPT to falsify information to be able to substantiate its points, you'd have to know that that data is contrived to be able to call it out. And when you call it out, it simply says, "Oh, thank you so much for helping me." It's like, wait a minute, I need you to help me with this stuff. So those are some of the concerns, and the percentages that I've seen are 10 to 20% likelihood that this could have a really significant, doom and gloom type scenario, upwards of 30%. And the people who are statisticians are saying that something that has that high a probability of detriment is something you should probably be careful of. And they make great examples of airplanes. And if there's a 20-30% chance that your plane would crash, you probably would never get in the plane. But here we are, and I don't think we're stopping it. So it is what it is, and we'll see. I think you're also right that government regulation could be problematic because we may have a different level of regulation than, say, China or some of our other national competitors or global competitors. So anyway, yeah, continue on. I just wanted to share a little bit about that, just to kind of demystify a few things, but also validate concerns from a statistical standpoint.
No, it's very, very important to get additional context there.
Yeah,
Um, so moving on, another big headline driver over the last, 90 plus days at this point has been the conflict going on in Iran, right? It's still obviously, as we sit here today, a developing situation. We thought we
yeah,
had some sort of pathway to this being resolved in shorter terms. And as we sit today, that seems to be very much in flux. But the main concern that everybody had, outside of the actual, human toll that, a war, causes, from an economic perspective, the main concern was inflation, higher energy prices. What is this going to do to, the future costs that the average citizen has to pay. When we saw energy prices come down because we thought that there was this kind of pathway out of this conflict, you saw energy prices go from $100 a barrel down to 70, basically back to where it was pre-war. This whole situation, market has taken it very much in stride, all things considered. From an inflation outlook, market has always been essentially thinking that this is going to be short term in nature. And that's
yeah,
what this chart here is trying to show. There's three different lines. Basically, it's the market's expectation of inflation 1 year out, 2 years out, and 3 years out. And so the more volatile black line here is going to be inflation expectations 1 year out, and then blue and yellow are going to be 2 and 3 years out. And so what you can glean from this is market 2 or 3 years out did not think that this war was going to impact prices in any way, shape, or form. This is always going to be much more shorter term in nature. And we did
mhm,
see this was as of a couple of weeks ago when we had that peace deal kind of in the works. That inflation was really expected to come down significantly, but even with a little tick up that we have here in the cost of a barrel of oil, we still see inflation expectations relatively muted at this point. And I think that's still our base case here at Horizon for inflation to not run away. But again, this is still very much a developing situation. We're
yeah.
hopeful that we come to some sort of resolution sooner rather than later here.
Yeah, I'm tracking with you. It's one of those things that we want to be short-lived, but these are the kind of things that can become protracted. And so I'm not a political scientist or anything like that. It just makes you wonder when people have access to what could be detrimental weapons, at what point do they grow frustrated and try and push the big red button and say, well, we're going to lose this thing anyway. So, of course, that would be a black swan event or a very unexpected, improbable type of thing. But it's watchful waiting for sure in the meantime.
Yep. And outside of that, and then we might have even talked about this last quarter, Chris. Um, with all the headlines, with all of the uncertainty going on in the Middle East, markets have been very, very resilient. You know, we're coming off of one of the strongest quarter performances for equity markets that we've had in a very, very long time. You know,
Right.
one of the main drivers for this, very strong, equity markets that we're seeing right now is just exceptionally strong fundamental earnings growth, corporate health here in the US, but then also globally, is just exceptionally strong. And that's what this here is showing basically change in earnings, change in profits for companies. This is around the globe, making, highs we haven't seen in a very, very long time. And it's worth noting that normally you don't see this level of increased profitability outside of, coming off of a recession. Usually in a recession, whether it was, 2020 or 2008, you have a huge dip in profitability, and then you have a bounce back because you're coming off of a low base. We are not coming off of a low base whatsoever. The last 3 years have been nothing but kind of improvements, steady improvements. What we're seeing right now is just exceptionally strong margins, exceptionally strong revenue growth, exceptionally strong earnings growth, pretty much across the board. A very, very good backdrop that's kind of putting a lot of the other noise. It's pushing a lot of the other noise that's going on to the side for right now.
Yeah, it certainly seems that way for sure.
Um, and then, the last main concern that we hear at Horizon, and I'm sure, Chris comes across is, this feels unsustainable. We've had the S&P 500 over the last 3 years has grown at 20% or more annualized, which is, very rarely do you see a situation like that. And especially when it's driven by technology, new technology that people don't necessarily understand, you get this comparison inherently to the tech bubble, right? And that's what this chart here is showing, the historic rise that you saw in tech stocks that really peaked right around that 2000 mark and then just completely crashed and just erased, a lot of money from markets. The one thing that we would really like to point out here is that you saw a pretty big disconnect between, the price of these companies, the price of their stock and the actual earnings growth that they were achieving. Earnings were not keeping pace whatsoever with the price of the stock, and so that's your classic bubble formation. What we're dealing with today looks very, very different. This is over the last 5 years, also looking at the same technology index. But here we're showing that earnings growth, and the earnings growth has kept pace, if not actually outpaced, the level of, or the price level. So the tech sector as a whole has actually not gotten more expensive. Valuations have not increased over the last 5 years, which I think would surprise a lot of people out there because you would just think that it has to. You can't go up 300% over the span of a couple of years and things not be more expensive. But it is true when you have earnings growth to the extent that we have, that is the case mathematically that things are not more expensive than they were a couple of years ago. And then, the last chart here, and again, it is going to, put today's or the rally that we're seeing right now in context with the internet boom that happened in the 90s. We are tracking what looks somewhat similar to, the rally that we saw in the 90s. You could take this a couple of different ways. Number one, the more optimistic way is that, there's a long runway still to go before we hit, peak valuations. And then again, at some point down the road, there is going to be, a bust. We are going to have a recession at some point down the road. We don't think that this time is going to be any different. Our view is that it's just not going to happen anytime soon. we do think that there is a substantial amount of additional upside here. So just continue to ride this exciting train. And we think that the rest of 2026 and 2027 are going to be pretty good for equity market returns.
Well, yeah, I would tend to agree from some of the fundamentals that I've been seeing, like you were talking about earnings growth. It doesn't, everyone can say it's a bubble just based on the price they see on, whether you're watching something on television, an app on your phone, or you're looking at your statements, you would say, hey, this just can't be sustainable. But there's merited belief that because the companies are earning. I think one of the things we talked about before, which we don't need to get into again today, but we talked about how much a function of GDP, the private capital investment is really that tailwind. So we're getting so much capital infusion from corporations wanting to push AI forward and be the first to market and also continue to innovate that we're getting some support in ways that is helpful. So the question just remains, which we can leave it as a cliffhanger, when do we run out of that capital, right? At what point
Mhm.
do we start having other issues? And so it'd be interesting to see also how that plays out. But I think in the meantime, we've had a hot summer. The market seems hot. Money seems hot. Um, this I'm now in my 27th year of doing it. When you went back to the chart earlier on the with the tech bubble, I believe it was two slides ago or a slide before. I started my career 2 months after the top of the Nasdaq bubble, and so that burst while I was trying to start at Morgan Stanley. And at some point, something will happen. It's just what does it look like, and how will we need to be prepared? So that's room and job security for the next quarterly review. So, yeah, I really appreciate your time, Casey. Thanks for carving out some time here today. And if you guys have any questions or concerns, I know recently we launched an alternative strategy that has some very speculative type positions, which may be a little bit more conservative in a way. And if you're hearing this and you're saying, "Hey, I don't buy it. I really want to do something a little bit different," just in the meantime, we're here to try and meet you where you are. This is based on a lot of research and a lot of belief. But at the same time, we're here to help you get where you want to go. And you don't necessarily have to listen to what we're saying. If you've got a gut that tells you or a hunch that tells you something otherwise, I've had some of the most unexpected clients make calls that I probably would not have made professionally, and it actually worked out for them. So this is your money first. We support you in that, and we're good stewards as best we can be as fiduciaries to help you get where you want to go. So in the meantime, you guys have a great next couple of months, and we'll see you again soon.